Hi, my name is Garth Mackenzie and I'm an ETF strategist and a technical analyst with Traders Corner. This week, I'm taking a look at the S&P 500 because it's been a rather brutal week on the market, as you would have seen last week. It was the fastest 10% decline on the S&P 500 on record. So certainly interesting times that we're living through. And we want to take a look at that and unpack it a little bit more carefully and take a look at the VIX index and how that relates to what we're seeing on the market at the moment. Now, my first chart today takes a look at the S&P 500 weekly chart, and it looks back over the last 6 years. And what you can see quite clearly at the bottom of this chart is the plotting of the VIX. Now, the VIX is the volatility index as measured by the Chicago Board Options Exchange, and that's the implied volatility that options writers use when pricing up options on the S&P 500. What's quite clear is that the VIX spikes when the market is in a state of flux, or in a case of a deep sell-off like what we saw last week. In the last 6 years, you can see there's been 5 separate occasions where the VIX index has spiked up to a level above 35. And we saw that last week. The VIX actually popped up to a level of 40 last week before beginning to turn lower. And you can see clearly on this chart how those VIX spikes coincide with the market in a deep sell-off state. Now, if we zoom in a little bit more closely on the situations in the past where the VIX has spiked, you'll notice that it's quite common for the market to rally significantly off the oversold level of a big sell-off, but then to double dip. And you can see that quite clearly in 2015 and 2016, and then again in the sell-off in late 2018 as well, where the market sold off. It bounced very, very violently, but then it did have a double dip after that. The one case in 2019 or late 2018 leading into the beginning of 2019 that was slightly different was where we saw the VIX index spiking again, but the S&P 500 actually made a V-shaped bottom in that case, which was unusual. And the reason for that instance was the Fed doing a 180 degrees about turn in terms of their interest rate policy. They had previously been talking of a rate hiking cycle beginning, and then they did a 180 degrees U-turn and started actually cutting interest rates. And as a result, we saw a V-shaped recovery into early 2019. Now, if we look at the more recent trading action in the next chart, it shows the S&P 500, the sell-off that we saw last week quite clearly, and it shows the corresponding spike up in the VIX. On Friday of last week, we saw a big reversal in the VIX index, and that coincided with a big reversal in the S&P 500 price itself as well. We've seen a very, very big rally in the market yesterday, that being Monday, and that's also not uncommon after a big sell-off like we've seen here. In fact, for the Dow, it was more than a 5% rally, and that was also one of the biggest rallies that we've seen on a single day in the last 80-odd years. So, and that type of trading activity is quite characteristic in nervous markets where you see big rallies like that. It's not always sustainable, and that's why on this chart I want to specifically take a look at the levels where we could see a potential bounce moving to on the S&P 500 before then a possible bit of profit taking and another dip down towards the recent lows. So a 50% retracement on the S&P 500 would come in at about 3122, and a 61.8% retracement is at 3187. You'll notice there's a gap in the chart there which coincides with the 50% retracement on the S&P 500. So my suspicion is that we see the market rally into that area, which we term the ambush zone, and then I think its chances are we see another leg to the downside. Now, if we move on to my final chart of the day, this is the ProShares Ultra Short S&P 500 ETF. This is a leveraged exchange-traded fund that is an inverse ETF mapping the movement on the S&P 500. I've spoken about this previously when it was down at $23 and said it was looking likely that it was a buying opportunity. It's since moved up 30% since then. Now, I think what we need to watch in the week ahead is for the ETF to pull back down towards about $25 per share, maybe $24 per share. And in that area, I think that's where we would look to start buying this ETF for then another rally. And that would imply then a bit of a pullback on the S&P 500. That's all I've got for you this time, and I'll be back with you with more market analysis and another look at some ETFs in the next episode.